Hello, everybody, and welcome to Hard Assets Investor. Well, today I have a very familiar face on the show here, Stephanie Link, who is the research director of TheStreet.com. You may see her often on television on CNBC. Glad to have you here,
Thanks
Stephanie.
for having me.
I should also mention that you're also the co-portfolio manager of Jim Cramer's charitable trust.
Yes, called Action Alerts Plus.
Very nice to have you here.
Thank you.
I want to talk to you about the basic macro outlook right now. You know, we continue to be in this very sort of difficult market environment, not just for equities, but for commodities, hard assets. How do you see the current environment, and which direction you think we're going to be going from here?
And that's the million-dollar question, right? I think that sentiment is extremely low. Right, expectations are very, very depressed at this point. Valuations for stocks and the market pretty attractive, and I know everyone talks about this. Yields, dividend yields, really attractive at this point, especially compared to the 10-year. Right.
Right.
And so you can kind of go whatever your style is. If you're a little more aggressive and you want to go with the aggressive growth stocks, there are definitely values there. But I'm a little more traditional and thinking, you can own some of these big blue chip, kind of boring names, and I think you'll do pretty well if you have a long-term time horizon. Yet
people still are very cautious. Yes. And over the last 3 years, we've seen the stock market basically double in value despite all the things that we have been through with the European situation and the debt ceiling debates and our own fiscal situation. Is that surprising to you that we've seen this continued sort of steady, it's been grudging at times, but this steady upward march in the market? Well,
certainly from the lows seen back in March. I think that if you look at kind of the big picture and you look at the economy, we're muddling through, right? You're running about 2%, 1.5%, 2% kind of GDP. Where are you going to go, though, around the world, where there's, where you can see productivity, where you can see companies really doing a great job at managing the bottom line and their growth? You have decelerating global growth, right, in China and in Europe and Latin America. So here we're muddling through, and yet we're able to produce mid-single-digit earnings growth.
Right. It's almost the classic wall of worry, right? I mean, if you look at, people have been afraid that we're going to have a hyperinflation because of central bank supposed money printing. Yeah. They've been talking about the collapse of the dollar, where actually the dollar's been doing quite well. Sure. Worries that interest rates are going to spike because nobody's going to buy our debt, yet interest rates are at all-time lows. And, of course, corporate profits that are at record highs, despite, as I said, everything that we've seen. So it's almost the classic wall of worry, isn't it?
Yeah, it absolutely is. And again, you go back to, as a stock investor, valuations. And then you get the dividend, so you get like a total package. And again, you don't have to go and be really aggressive and speculative in terms of what you're finding. When you can get a McDonald's for a historically low multiple, or a Yum Brands, or a Kellogg, or a Kraft, and I know those are kind of boring names, but I think there's certainly room to make money at this point in a lot of different areas.
Let's look a little bit at the commodity raw materials sector, which has had a huge run. We can go all the way back, I guess, to 2001 when gold really started to move, and then you had the oil move and other commodities that really broadened out. Recently, we've seen that trend kind of, get a little bit weaker. Mm-hmm. Do you think this is just, a moment, a correction, and that longer term, that hard asset, class is still going to be very much in favor?
I think it's a place to put up some of your money, not all, right? So you always have to have, I believe, some part of your portfolio in commodities, and I do believe that the energy sector in particular has really gotten hit this year, one of the worst sectors in the market year to date. And yet I do believe even though the global economies are slowing, I think the big key is going to be China. Can they soft land? And if they can soft land, you absolutely want to be buying these energy stocks across the board.
Well, let me ask you, do you think they can soft land? I mean, I've never seen really a soft landing, but,
Most people will say they don't believe the numbers out of China. We're given what we're given, right? And I do think
they say that about the U.S. too, but the same thing applies.
I would say that in China, the good news is that they're starting to ease. I'm not surprised that they're starting to ease. Our portfolio is positioned for them to ease. Whether they grow at 6% or 8%, I think it's okay. We have to see a stabilization, though, in their economic data. And I think you've seen a lot of manufacturing data, a lot of
loan growth coming back.
Yes, and exactly. I do think so. I think you can kind of go 6 to 8%, and if you do believe that that's the growth that they can accomplish, then you do want to be part of commodities. They're one of the largest buyers of commodities.
Absolutely,
so it's across the board. The one commodity area I'm less excited about is aluminum, because there's a lot of it and it's easy to make. But if you look at copper, hard to get, right? Gold, really hard to get. Energy, it's not hard to get, but we make it hard to get, you know? So I think that, again, I think that there's a place in your portfolio for it.
Now, one sector of the energy has been natural gas, which has really, really surprised people as to its weakness. Yeah. What's your outlook there?
See, I actually think we're bouncing along the bottom. We have a lot of it. We're drilling like mad to get it. Although, if you want to look from a valuation point of view or a stock point of view, I think we're bouncing along the bottom. The biggest users of NatGas is the industrial sector. The industrial sector is seeing a little bit of a level off, right? I think we kind of peaked in March in terms of our economic data, and now we're kind of leveling off. If, in fact, we can continue to see, this level off, I think that means you probably have a bottom in NatGas. Does that mean it's going straight up? It's very weather dependent, and it's very, a lot of trading. There's a lot of trading going on.
We still have a lot of supply, so it's doubtful that it'll go straight up.
But so the way to play it, the way we've been doing it, is actually buying the companies that use it that are going to benefit because it's so low.
Right, exactly.
So their cost structures are really helped, and that's really consumer and consumer-related companies.
Now, looking out into next year, 2013, we hear a lot about the fiscal cliff, the spending cuts, and possibly tax increases. How do you think that's going to play out?
Well, that's a really good question. You're asking all the hard ones today. It's hard. It's hard to predict what's going to happen. You would think that they would come to a resolution after what we just went through last year. I think, obviously, we have to get through the big election first and get through who is going to be running, who's going to be the president, what does the Congress look like. I think, you will get a divided Congress, no matter who wins, which will probably be positive for us overall. But then, in terms of making the progress on the fiscal cliff, that's it's a wild card right now.
But if we do pull back on those tax increases, maybe pull back on the sequestering as well, the spending cuts, it looks pretty bullish, doesn't it?
Absolutely. That's a huge issue. We had to get through Greece.
Right.
Now we have to get through Spain and Italy, and we're going to see what happens there. If we can then get through the next big hurdle, which is the fiscal cliff, it's kind of all systems go, which would be quite nice. And then again, coupled with the valuations, coupled with the attractive dividend yields, you can be very bullish. I think you have to be kind of the way we are positioned. We have some defensive stocks and we have some cyclical stocks, so that you at least participate and you're protected on the downside on the really bad days. But then if you do have the market take off, we actually have some exposure.
Well, I'm going to go with being very bullish.
Okay.
Right. Thanks very much,
Thanks.
Stephanie Ling. That's it for now, folks. This is Mike Norman. See you back here next time. Take care. Bye-bye.